I was recently sitting at a quiet corner table in a high-end coffee shop in Singapore's financial district. At the table next to me, there was a peculiar pair, an older gentleman in a crisp, traditional Standard Chartered suit, and a younger person in a black tech hoodie with a small and international logo. They weren't looking at stacks of paperwork or even standard bank statements. Instead, they were huddled over a single tablet, watching a digital ledger flicker with what looked like lines of code. The younger one tapped the screen, leaned back, and whispered, "It's live, tokenized." To an outsider, it looked like they were playing a high-stakes video game. But in that moment, millions of dollars in real-world assets were being converted into digital tokens, moving across borders with the speed that makes traditional wire transfers look like carrier pigeons. What struck me wasn't just the technology, but the casualness of it all, as if they were simply ordering a coffee rather than rewriting the rules of global finance. For decades, the world has looked at Southeast Asia through a very specific lens. The world's factory, a place of sweatshops, cheap labor, and massive shipping containers. We've been conditioned to see it as the muscle of the global economy, not the brain. But while we were busy looking at factory floors, the entire plumbing of the region's financial system was being ripped out and replaced. The announcement that dropped on December 18th wasn't just another corporate partnership. It was a signal that the cheap factory era is over. Singapore has become the launchpad for a new kind of war, a payment war where the territory isn't land, but the digital wallet of every person in the ASEAN region. We are witnessing the moment where crypto stopped being a speculative bubble and started becoming the invisible engine of cross-border trade. It makes you wonder, if the money is no longer real in the way we understand it, is the economy we thought we knew already gone?
That analogy, the shift from muscle to the brain of the global economy, is, I think, a perfect way to frame this whole deep dive.
It really feels like that, doesn't it?
It does, because we aren't just looking at, a couple of successful tech companies popping up in Southeast Asia. We're really analyzing how Singapore is.
Yeah.
Well, it's strategically engineering the next generation of global financial infrastructure.
Right. This isn't happening by accident.
Not at all. The technology is very real, the institutional buy-in is massive, and the economic implications for the entire ASEAN region are, frankly, staggering.
Okay, so let's unpack this. Our mission today is to really deep dive into this technological and strategic pivot. It's not just about that single blockchain deal between Standard Chartered and International you mentioned.
Exactly.
It's about how Southeast Asia, and specifically using Singapore as this, what did you call it, a highly curated launchpad.
A curated launchpad, yes.
It's redefining its entire role through digital finance and payment innovation. So for anyone listening, what are the key concepts they need to lock onto before we really jump into the mechanics of it all?
Okay, three big things. First, and this is the core technology, is tokenization.
Tokenization.
Yeah. And specifically, we need to think about how traditional rock-solid assets, like your currency deposits, are being converted into what are called real-world assets, or RWA.
RWA.
And these are assets that are instantly transferable on a blockchain. So that's number one. Second, we have to understand the, let's be honest, the boring but absolutely critical world of cross-border corporate treasury.
The plumbing.
The plumbing. It's the financial circulatory system for any multinational corporation that's trying to operate across Asia. And then finally, we have to grasp the really unique nature of Singapore's highly curated tech ecosystem.
Curated. That word keeps coming up.
It does, because it's not just business-friendly in a generic sense.
Yeah.
It is actively, and I mean actively, designed to enable these revolutionary financial breakthroughs.
That's a huge shift in focus then. I mean, we are moving from the speculative Wild West edge of crypto straight into the institutional button-down core of global banking.
That's the story.
Let's start with that collaboration then. You've got this incumbent banking giant, Standard Chartered, and this fintech powerhouse, Ant International. It just feels like a perfect microcosm of the systemic change we're talking about.
It is.
Because when we hear tokenization, I think most people still think of, speculative coins or NFTs.
So Bitcoin, Ethereum.
Exactly. But this deal is about something much more fundamental, tokenized liability management. What does that actually mean, and why is that so different from just a normal bank deposit?
Okay, so what's happening here is the transformation of just basic bank deposits.
Yeah.
In this case, we're talking about Singapore dollars and US dollars into tokens. But these tokens aren't a new currency. They represent the bank's liability to the client. The bank's IOU, essentially. This collaboration is using blockchain technology not for some new volatile currency, but for managing the immutable record of who owes what to whom.
So it's about the record keeping.
It's all about the record keeping. And the crucial difference is two things: interoperability and speed.
All right, but here's what I don't get. Standard Chartered already knows how much money a corporation has in its accounts, right? They have a ledger. Why do they need to tokenize it? Why bring in a distributed ledger? And why partner with Ant? Couldn't they just, manage their own internal system?
That's the critical question. And yes, they could manage it internally, and they do. But the moment that multinational corporation, that MNC, needs to move that liquidity, that cash across a border.
Oh, okay.
Let's say from a treasury hub in Singapore to a manufacturing plant they own in Thailand, that's where the old system just breaks down. They're forced into the traditional correspondent banking network.
The SWIFT system.
The SWIFT system, which is slow, it's expensive, and it's opaque. By tokenizing the deposit, they create a digital claim, a digital bearer asset, that can move instantly and atomically between recognized parties on a controlled blockchain network.
So it's not about creating a new asset at all. It's about creating a new railroad for the existing assets, a radically faster and more efficient railroad.
Precisely. That's the perfect analogy. The whole strategic aim here is to increase cross-border corporate treasury efficiency. And you have to think about the scale of a massive MNC.
Right.
They might have hundreds of different legal entities across Asia. They're all generating revenue, different local currencies. They're needing to settle invoices, manage their foreign exchange exposure, and move excess cash back to a central treasury account. It's a logistical nightmare.
So walk me through it. Let's say that MNC needs to pay a key supplier in Vietnam on a Friday afternoon. Their cash is sitting in US dollar deposits in Singapore. How does the old system, the legacy system, handle that?
Well, in the legacy world, the SWIFT world, that transaction involves multiple banks. You have correspondent banks, intermediary banks. It goes through multiple clearing cycles.
So it's not direct.
It's not direct at all. And it often results in a settlement lag of, say, 2, maybe 3 days. And during that time, the company's facing a ton of risk. There's counterparty risk. What if one of the intermediary banks has an issue and fails to settle? There's significant foreign exchange risk or FX risk. The price of the Vietnamese dong versus the US dollar can change a lot over 2 or 3 days. And of course, there are high fees at every step. This latency, this friction, it's a huge pain point for corporate treasurers.
And this Stand-Chart and Ant framework, it just removes that friction by providing instant finality? Is that the idea?
Yes. The moment the token is transferred on the digital ledger, the transaction is settled.
Yep.
It's done. This digital workflow, it significantly reduces the difficulty of settling transactions across all these different markets.
And it's 204/7.
It provides instant, round-the-clock management of funds. The source material we looked at noted this is especially beneficial for these global companies. They're basically turning the movement of corporate cash from this cumbersome 9-to-5 banking procedure into a seamless 247 digital ledger entry.
And that eliminates hours, maybe days of waiting and all the risk that comes with it.
All the associated risk, gone.
It sounds less like a revolution in currency and more like a revolution in accounting and, risk management. This tech is becoming essential infrastructure. It's not just optional window dressing anymore.
That institutional recognition is the key. That's the whole point.
Yeah.
Our sources explicitly state that asset tokenization is, and I'm quoting here, no longer optional for financial institutions.
No longer optional.
It is moved from the experimental sandbox phase, which, by the way, the Monetary Authority of Singapore, the MAS, has been incredibly active in.
Right. They were trialing tokenized bills.
Exactly. They were already trialing tokenized government bills. So it's moved from that sandbox phase into being seen as essential infrastructure.
So the regulator isn't just passively sitting back and watching. They're actively facilitating this. When the MAS trials tokenized bills, it sends this powerful signal to the entire global banking community. It's basically saying, this is happening, and we are prepared to integrate it into our sovereign infrastructure.
That's exactly right. And you have to understand, this specific Stand-Chart and Ant partnership, it didn't just appear out of thin air. It utilized a controlled, highly supportive environment. The strategic role of Singapore's regulatory sandbox was absolutely critical in facilitating this.
What does that mean in practice, the sandbox?
It means it allows 2 major financial players, one, a massive Western incumbent bank, the other, a massive Chinese fintech giant, to come together and co-create a very sensitive cross-border system, but they're doing it under the direct oversight and guidance of the MAS.
So it minimizes risk?
It minimizes risk, and it massively accelerates deployment. This high-trust environment is something that other financial centers, London, New York, They really struggle to replicate that level of proactive collaboration.
But is there a risk of over-curation here? I mean, if the MAS is so directive in how these banks adopt blockchain, does that stifle the true sort of decentralized innovation that crypto was originally built on? Are we just creating blockchain with guardrails that limits its revolutionary potential compared to, say, pure DeFi?
That's a really valid concern, but I think from the institutional perspective, the guardrails are the revolution.
The guardrails are the feature, not the bug.
Exactly. An MNC treasurer or a major bank is not going to entrust billions of dollars of corporate treasury to some anonymous, permissionless network. It's just not going to happen. They need compliance, they need regulatory clarity, and they need to know who their counterparty is.
So Singapore's model, which is a permissioned, regulated blockchain network grounded in familiar assets like SGD and USD.
It provides the trust needed to move the technology from speculation into the engine room of global commerce. This is what institutional crypto adoption actually looks like. It's driven by efficiency, not by ideology.
And this tokenization is central to the evolution of the whole ASEAN region's broader digital payment landscape.
Absolutely. If we connect this to the bigger picture, the entire ASEAN region needs better digital plumbing. I mean, to facilitate multi-currency settlement and expand local currency transactions across the entire ASEAN +3 region, you need technological solutions that can handle rapid, low-friction exchange rates and settlement.
And these blockchain-based solutions are the mechanism.
They are the mechanism. It allows the region to build a digital highway for money that lets all these regional economies interact instantly without constantly being forced back through legacy systems that, let's be honest, often rely on slow, expensive US dollar clearing processes.
So, in a way, Singapore is solving a regional economic problem by building global-grade infrastructure.
That's a perfect way to put it.
Okay, so we've established that the technology is revolutionary and the regulation is incredibly forward-thinking. Now we need to look at the foundation of it all. Why Singapore? Why is this specific city-state the place where all these major Western and Eastern financial players converge to build this global future? It has to be more than just, low taxes.
It's so much more. It's about trust, certainty, and connectivity. When companies decide to anchor their core R&D, their payments engineering, their regional headquarters somewhere, they're entrusting that place with their most sensitive intellectual property.
Their crown jewels.
Their crown jewels and their long-term strategic plans. And Singapore has cemented this standing through incredibly deliberate, data-driven policy. It's not an accident.
Let's just start with some of the hard data on its global competitiveness. I think we have to contextualize this for people listening. I mean, outside of Silicon Valley, Singapore is ranked the top tech innovation hub globally.
Which is an incredible stat on its own. But then you look at its regional strength. It ranks second in digital competitiveness in Asia. And think about who that puts it ahead of. It's surpassing technology powerhouses like South Korea, Japan, and China.
That's amazing.
It is. It implies that while these larger nations might have massive scale and capacity, Singapore has this unparalleled focus, quality, and administrative efficiency. It knows exactly what sector it wants to dominate digital services and finance, and it resources that goal relentlessly.
And it's not just tech. It's quality of life and smart infrastructure. It ranks first in the Global Smart City Index.
Right, and that title requires this seamless integration of digital infrastructure into daily life. It's beating global cities like London and New York. That level of connectivity is absolutely crucial for a financial brain center.
But I think this next one is the most critical. Its strength lies in protecting the ideas. It's ranked first for the most innovative economy in all of Asia, but that innovation is protected by being ranked first for intellectual property protection in Asia and second globally.
And that IP protection is the absolute unseen pillar of this whole structure. Without legal certainty, the money leaves, the R&D leaves. When a company like Microsoft is developing its next generation AI or its payment rails, they have to know that their IP is safe.
That legal certainty then underpins the massive concentration of corporate power we see there. I mean, Singapore hosts 46% of all Asia regional headquarters across various industries.
Which is already a huge number.
But then if you drill down into the technology sector specifically, that concentration jumps to 59% of Asia regional headquarters for technology multinational firms. That creates this powerful, self-reinforcing gravity.
It creates an ecosystem where talent, capital, and competing ideas are just constantly interacting and bumping into each other. And the infrastructure supporting all of this concentration is just world-class.
Yeah.
We can't overlook the physical plumbing here. The cables. Singapore is the top global submarine cable hub. It's linked by 24 different cables, and it handles over 60% of the entire Asia-Pacific's data center supply. For 247 digital finance and data-intensive R&D, that physical connectivity is the bedrock. You can't do this without it.
Okay, let's talk about some of the specific American tech giants. We can't just list them off. We need to understand the strategic importance of what they are actually doing there.
Right. Take Microsoft. They have their Asia-Pacific HQ there, sure. But the key detail is their Global Transparency and Cybersecurity Center.
Okay.
The place where governments and major clients go to check Microsoft's security protocols and source code is their first one globally. They chose Singapore to host their ultimate security secrets. That signals this profound trust in the government's stability and its legal framework.
And Dell Technologies, they're not just running regional sales out of there. They've anchored their global innovation hub in Singapore.
And that hub is focused on high-stakes, multi-year strategic R&D. We're talking augmented and mixed reality, advanced data analytics, next-generation cybersecurity. They're using Singaporean talent to ideate and experiment on products for global markets, not just local ones. It's a design center for the future of their entire enterprise business.
Google's presence is also fascinating because their focus seems so intrinsically linked to the regional growth story we're tracing.
It is. Their Asia-Pacific headquarters is there, of course. But their core engineering teams are focused on two really strategic areas: payments and what they call the Next Billion Users Initiative, or NBU.
The next billion users.
And this is so powerful. They aren't building products for people in Manhattan or London. They're specifically designing the digital wallet and the search experience for someone getting their first smartphone in Jakarta or Hanoi or Manila. That mandate design for the massive, rapidly digitizing population of Southeast Asia fundamentally shifts their product strategy, and it places Singapore right at the heart of their future growth plans.
And it's not just the classic tech companies. The global payment powerhouses are treating Singapore as their R&D lab for all of Asia.
Exactly. MasterCard established its MasterCard Labs in Singapore. And they're there to design tailored digital solutions for tourism, urban mobility, and trade, specifically partnering with local Asian companies. Visa did something similar, establishing its first innovation center in Asia and Singapore way back in 2016.
And they run their accelerator program from there.
They do. They use it as a regional magnet to jointly create new applications with their clients and partners, focusing on the specific complexities and challenges of Asian payments.
And PayPal's commitment seems equally deep. Their international HQ is there, but they also host the Asia Pacific Cyber Defense Center and, maybe most importantly, their innovation lab, which is the first one they ever built outside the U.S.
And that lab serves as a core research center. It's focused on highly sensitive core competencies like AI and machine learning applied to financial services. It shows this deep, long-term strategic commitment to exporting innovation out of Singapore, far beyond just simple regional operational support.
This brings us to a really crucial geopolitical point, one that I think validates Singapore's position as this neutral but potent financial arbiter. And that's the rise of these powerful Chinese fintech leaders who are using Singapore as their primary springboard into the wider Southeast Asian market.
Absolutely. We're calling this the Chinese fintech springboard. For these Chinese tech giants, Singapore provides the ideal, neutral, high-trust regulatory environment for them to expand outside of, mainland regulatory oversight.
It's a safe zone.
It's a safe, trusted, and robust hub for regional expansion. And it doesn't have the political friction they might encounter in other parts of the world.
So what are companies like Tencent doing there specifically?
Well, Tencent established its regional hub in Singapore for its massive global games operations. It's rapidly expanding Tencent Cloud engineering and its WeChat product operations. They are running core global revenue-generating product lines out of Singapore. It's not a peripheral office. It's central to their entire international strategy.
And Alibaba, leveraging its acquisition of Lazada, seems to use Singapore for strategic regional control.
Yes. Alibaba Cloud Intelligence, which is critical for supporting its huge e-commerce and logistics ecosystem, uses Singapore as a hub for a diverse range of business units. They leverage that base to help regional businesses tap into its cloud technologies for growth, essentially positioning Singapore as a control point for digital services across Asia.
And even the newer generation of tech titans, like ByteDance and Zoom, they're committing major R&D funds there.
ByteDance has significantly ramped up its investment commitments. They're focused on growing deep tech, engineering, and R&D talent, including machine learning scientists and algorithm engineers. They need Singapore's talent pool and its stable environment to manage their exponential regional growth.
And Zoom.
Similarly, Zune opened an R&D center there, and they explicitly cited the superior connectivity and business-friendly environment as the reasons to leverage the city-state for their regional expansion.
So, it doesn't matter if you are a U.S. giant looking for cybersecurity certainty, a global payment processor needing an R&D lab for Asia, or a massive Chinese fintech seeking a neutral launchpad.
Food. Singapore is the consensus choice.
It has secured its position not through luck, but through this deliberate strategic engineering of its entire ecosystem.
Exactly. And that concept of strategic engineering is what we need to dive into now. This isn't just about market forces. It's about the government actively curating and streamlining the path from an idea, from innovation to commercial success.
Right. The government isn't just a referee, it's a player on the team.
It's more like the coach. It acts as a single coordinated strategic partner. And this coordination is embodied by the Digital Industry Singapore Office, or DSG. It's basically the front door for global tech leaders.
Okay, so explain how DSG brings together all the government's capabilities. It's not just one ministry doing its own thing, right?
Right. DSG is a strategic triumvirate. It's designed to do three things: anchor global tech leaders, build local champions, and nurture talent. And it does that by merging the capabilities of three key agencies, which ensures a cohesive approach across investment, regulation, and enterprise growth.
So the first part of that triumvirate is the Economic Development Board, or EDB.
The EDB is the primary investment attraction arm. They offer the toolkit for international investors. We're talking strategic connections, resources, and crucial financial incentives. They're focused on landing the big strategic headquarters, making sure the business environment is globally competitive.
Okay, then next up is the Infocom Media Development Authority, IMDA.
IMDA is the ecosystem developer and the regulator. They are responsible for these crucial programs like the Tech Skills Accelerator, or TESA for talent, the Open Innovation Platform for problem solving, and the Accreditation Program for validation. They basically develop and regulate the digital and media sectors to ensure there's a fertile ground for innovation to grow.
And the third part is Enterprise Singapore, or ESG.
Right. ESG focuses on the growth and internationalization of Singaporean businesses. They champion enterprise development, making sure local companies have the resources they need to scale globally. They also support Singapore's role as a hub for global trading and startups.
So you have this three-pronged approach. EDB brings the investment in, IMDA develops the ecosystem and provides the sandbox, and then ESG helps the companies grow and scale.
It's a complete pipeline. And this leads us to the crucial part of the curation: fast-tracking acquisition and validation. It's one thing to have a great piece of technology. It's a whole other thing to get a major, trustworthy first customer.
That's where IMDA accreditation comes in.
That's where it shines. It acts as a government-backed, third-party validation system for Singapore-based enterprise tech companies. This stamp of approval, it significantly reduces the procurement risk for major buyers, including the government itself and large MNCs. It makes it so much easier for an innovative local firm to land that first major contract.
What are the tangible results of a system like that? Does it actually work?
The results are pretty astounding. The accreditation program has created over 814 million Singapore dollars. That's nearly 600 million US dollars worth of project opportunities. It's resulted in over 2,000 project awards.
That's how.
And the proof of confidence is that 11 accredited companies have already achieved successful exits, either through acquisitions or IPOs. It's a proven success.
The Data Robot case study is a perfect example of this. It shows that flywheel effect in action.
It's a great example. Data Robot is a major US-based AI firm. They needed to prove their platform in the Asian enterprise context. So after they received the IMDA accreditation, they secured a major government contract.
And that government validation was everything.
It provided the necessary confidence, which then led Data Robot to subsequently anchor their regional business headquarters and expand their advanced R&D center in Singapore. The government used its own purchasing power to validate and then anchor a global tech leader.
That is a highly intelligent use of government procurement. It's not just buying services, it's a strategic tool for economic development.
It is. And the other critical tool for linking ideas to commercial application is the Open Innovation Platform, or OIP.
Right.
The OIP addresses that classic gap between abstract research and real-world business needs. It's a virtual crowdsourcing platform that issues innovation calls a few times a year. These calls present complex, multidisciplinary challenges that are submitted by what they call problem owners, major industry players, or government agencies.
So instead of a startup inventing something cool and then desperately looking for a problem that it can solve,
Which happens all the time.
the OIP provides the problem first. It ensures that the solution has an immediate, massive, and paying market.
Exactly. It systematically invites tech companies, research institutions, and even individuals to co-innovate, which leads to high-impact proof of concepts and prototypes. For instance, through the OIP, a travel tech company called Vouch developed a reservations concierge that helped major hotel chains like Fraser Hospitality and Pan Pacific automate their check-in and internal processes. It's a mechanism that forces collaboration and accelerates commercialization by matching proven demand with proven supply.
Of course, all of this depends on the third leg of the stool, the talent pipeline. Without the human capital, this whole engineered ecosystem just crumbles.
Singapore is just maniacal about talent. It's ranked top globally for its efforts to transition workers to a digital economy. It's also third globally for fostering and attracting talent.
And there's a demographic advantage, too.
A huge one. The data is powerful. 74.3% of the resident population is literate in 2 or more languages. That linguistic flexibility is absolutely indispensable for a regional hub that has to serve these highly diverse markets like Indonesia, Malaysia, and Vietnam.
And they are actively competing for global talent. They have this new 5-year One Pass, which is specifically designed to attract the world's highest earners and most skilled professionals. But the most interesting part of the talent strategy to me is this deep industry-academia collaboration, creating what you called living test beds.
Yeah, this is a physical integration of research and commerce. The Punggol Digital District is the perfect example of this master plan. It houses key growth sectors, cybersecurity, IoT, right next door to the Singapore Institute of Technology.
So it's intentional.
Completely intentional. This proximity is designed to facilitate rapid prototyping, testing, and commercialization by creating physical closeness between students, researchers, and company engineering teams.
And this is where we see the rubber meet the road in R&D. Let's look at some specific collaborations between universities and industry.
The Grab US AI Lab is a prime example. They use Grab's enormous data set. We're talking real-time, complex mobility and transaction data from across all of Southeast Asia, and they combine it with the AI expertise of the National University of Singapore and US.
So students are working on real-world problems.
Postdoctoral and PhD students are tackling actual urban mobility challenges like mapping traffic patterns or optimizing delivery routes. It fosters local talent development while solving commercially viable problems for Grab.
The impact of a collaboration like that is regional. I mean, they're mapping the DNA of movement across millions of people in key Asian cities.
It's incredible. Salesforce also recognizes this talent advantage. They established an AI research hub with the aim to train up to 100 postgraduate students over 3 years. And the research focus is very strategic.
What are they focused on?
Deep learning, machine learning, and critically natural language processing, or NLP, but specifically tailored for Asian languages. If you want to build the best chatbots and AI interfaces for the 630 million people in ASEAN, you need local language experts and local data. Singapore is actively producing both.
And PayPal's Innovation Lab just further solidifies this. It's a core research center for AI and machine learning, actively collaborating with institutes of higher learning and SMEs to develop proofs of concept and transfer that technology into the commercial realm. The whole ecosystem is just wired together for speed and high-impact innovation.
So we've covered the technical breakthroughs with tokenization, and we've covered the foundation of trust and talent with Singapore's curation. Now we have to address the ultimate purpose of all this, capturing the colossal, rapidly expanding Southeast Asian digital payment market. This is the prize. This is what justifies all that infrastructure investment.
The scale is often lost on listeners in the West, I think. We are talking about the ASEAN region being home to 630 million people.
And this population is young, they're mobile first, and they're digitizing faster than almost anywhere else in the world. The economic opportunity is just vast. I mean, consider just the online media sector. It quadrupled between 2015 and 2019 from about $14 billion, and it's forecast to reach $32 billion by 2025.
That kind of exponential growth requires infrastructure that can actually handle that surge in digital transactions.
It does. But the truly revolutionary aspect of this digital shift is its potential to address the massive financial inclusion gaps in the region. The opportunity is driven not just by new wealth, but by the fact that the majority of the region remains fundamentally underserved by traditional banking.
That is the core social and economic catalyst, isn't it? The traditional banking system has, for the most part, failed to serve the majority of people. Over 70% of Southeast Asia's adults are underbanked.
And that means they might have a basic bank account, maybe, but they lack access to credit, to wealth management, or to efficient cross-border payments.
And this problem is amplified by the sheer number of small businesses that are the true engine of regional trade.
Absolutely. Roughly 80% of micro, small, and medium-sized enterprises, the MSMEs, lack access to affordable credit. This is basically an economic emergency. These MSMEs are the catalyst for unlocking value in the region. They constitute a massive 97% of all regional enterprises.
97%.
And they employ 69% of the workforce. Yet, because they are starved of capital and efficient infrastructure, they only generate 40.5% of the average GDP.
That disparity just screams inefficiency. The fact that nearly 3/4 of the workforce generates less than half the GDP, it just shows how badly they need access to capital and low-friction payment systems to grow.
And this is where the Singapore-based fintech solutions, enabled by that tokenization infrastructure we discussed earlier, really step in. Digitalization offers this immense potential to unlock all that latent value. The goal of this payment war is seamless cross-border activity, and it's tailored specifically to these small businesses.
So how exactly does something like tokenization and blockchain help an MSME that has no credit history get affordable credit or make cheap cross-border payments?
Well, the ability to conduct transactions instantly and transparently via a regulated digital ledger, whether it's the high-end central chartered system or a broader fintech platform, it allows for new mechanisms. For instance, MSMEs can benefit from alternative credit scoring that's based on verifiable digital ledger data rather than just traditional bank records.
So it creates a new kind of financial identity for them.
A new, trusted financial identity. And furthermore, the efficiency gains from that tokenized multi-currency settlement system, they flow down to the consumer level. It makes remittance and business-to-business payments faster and cheaper for even the smallest traders.
And we see fintechs directly addressing these gaps, leveraging Singapore as their Asia-Pacific hub.
We do. Companies like Wise operating from their hub in Singapore are fundamentally modernizing this process. They are directly addressing that MSME cross-border pain point by launching low-cost offerings like fast transfers from India or providing Wise accounts and debit cards in Malaysia.
Things that help with cash flow.
Exactly. These offerings help small businesses manage cash flow and secure working capital across the region without all that traditional bank friction. They are the distribution layer for the foundational infrastructure that's being built by the giants.
So the institutional adoption of tokenization isn't just some novelty for global giants. It's the infrastructure that facilitates fintechs like Wise to serve the MSMEs more effectively across multiple jurisdictions. The tech developed in the regulatory sandbox is now directly enabling financial inclusion in Jakarta and Manila.
It's a perfect feedback loop. The integration of real-world asset tokenization and these blockchain solutions is fundamentally modernizing the process for multi-currency settlement. If cash management for the largest MNCs becomes instant, well, the path for simpler, more local currency transactions across the whole ASEAN +3 region opens up for everyone else.
So this strategic evolution of ASEAN's digital payment landscape, catalyzed by Singapore, is the mechanism for unlocking the GDP growth of 630 million people. The payment war isn't just for profit.
It's a war for efficiency, for inclusion, and for the economic future of the entire region.
And by curating the environment, attracting the best talent, enforcing rigorous IP protection, and mandating these forward-looking regulatory guidelines, Singapore has cemented its position as the critical command center for that entire regional digital transformation.
What this deep dive really reveals is a profound strategic shift. Southeast Asia is not merely consuming global technology anymore. It is actively designing, building, and exporting the core infrastructure of the future global economy.
It's a fundamental change.
The region is moving from being viewed as the global muzzle, the factory floor, to becoming the primary engineering brain of next-generation global finance.
And this highly structured, government-supported ecosystem, coupled with the institutional buy-in on tokenization and digital ledgers, it means that the entire operational map of cross-border trade is being redrawn right now. The physical location of assets is, like you said, it's becoming secondary. The ledger, the shared digital record of ownership and liability, that's the new foundation of cross-border trade.
And if the new payment rails of Asia are being designed, built, and controlled out of a single strategically engineered city-state that sits at the nexus of US, Chinese, and regional tech giants, then the core flows of Asian capital are, in a way, becoming digitally sovereign. The real question for the future is not simply how this money moves, but what degree of influence Western central banks will retain over capital flows that are now fundamentally routed, settled, and regulated through Singapore's unique tokenized digital architecture.